Welcome back. I just want to briefly go into variable costing versus absorption costing. So let's take a look, and I got a couple of slides. I'm not going to go into a lot of details on this, but just be aware that there are two methodologies associated. And when we're doing costing, costing is really important when we're considering how we're going to be selling, analyzing our cost, and seeing if we can be profitable. So the information managers helps us set prices, controls costs, and evaluate performance. So that's what we're doing here. But there's two major categories of costing. There's variable costing, which is direct materials, direct labor, and variable overhead. And there's absorption costing, which absorbs more costs, which adds fixed manufacturing overhead to the mix. So this is going to give you a little bit more, I'll say, accurate data, but it's also going to potentially inflate some of the inventory valuations if we use this as part of our financial system. So notice absorption costing, fixed manufacturing overhead is not included. If you look at that and say, oh, I've got 240 in variable costing, absorption costing of 315. When we did some analysis before, we were saying, do we accept a special order? And we said, well, if our variable costs, if we got a special order for $2.90, that'll take care of all variable costs. It won't contribute to our fixed costs. But you know what? Actually, it will, because we're going to make 50 cents more over variable. But this is already a sunk cost. Our fixed costs are done for. We're going to have those whether we accept the next order or not. So we're looking at the marginal cost, the difference in costs, and making our decisions. So we go through, and there's some examples here, absorption costing that talks about using, because fixed manufacturing overhead rates are assigned to ending inventory, costs attached to unsold units are not expensed until they are sold. This increases our inventory value. If we're absorbing those fixed costs, that's going to take funds, monies away from our income statement, move up to the balance sheet. It's going to result in higher profits and better performance. You say, I can actually, by changing a methodology, affect my net income and profitability? You bet. So that's why we're just talking about it, just to be aware of it. Okay. And because only variable costs are assigned to ending inventory in a variable costing example, all fixed manufacturing overhead costs appear as expensed and reduce profit under variable costing. So that's what we're looking at. And we're trying to look at the differences between the absorption costing and the variable costing. So summary, we're looking at the effects on inventory costing. All right. When production is greater than sales, or production equals. If production equals sales, we're good to go. Production is greater than sales, absorption costing ends up increasing our inventory. Increases our inventory, increases our bottom line net income. Okay. And based on production, absorption costing inventory declines more than variable costing inventory if sales is greater than production. So that's the variation. If we're selling more than we produced, we're going to be using up that inventory and taking it away. And the summary that goes with that is variable costing matches the direct product cost with revenues. By omitting fixed costs from inventory, variable costing understates long run variable costs and misleads decision makers into underestimating true product costs. But you always have to be careful, because fixed costs, if you make a decision, well, you know what, I'm not profitable. You still might be more profitable selling at below your total costs, because if you stop producing, those fixed costs are still going to be there. All the other costs are going to go away. Materials and conversion costs, or materials, labor, and overhead, will stay. So as long as you're covering those, at least you're contributing something to the fixed costs, even if you're still losing money. If you close that division, you probably still have the fixed costs unless you can get to sell off the division. Those fixed costs are still going to be incurred, and you're just not going to have any of the revenues to offset that in the excess of materials, labor, and overhead. So that concludes this particular module, and hopefully you've got a better feeling and understanding of how this costing kind of fits together and works together. Thank you for investing your time. We'll look forward to our next and continuing. We're getting close to the end. We'll get more information on managerial accounting, costing analysis, and making sense of this all. Thank you so much.